For more than a decade, the crypto market had this predictable rhythm, right? The Bitcoin halving, it kicked off a 4-year cycle of boom and bust that you could pretty much set your watch to. But here we are in 2026, and it feels like that watch is just broken. After soaring to an incredible new peak of $126,000, the market has pulled back, and it's pulled back hard, hovering around 60K. So the big question is this just another one of those gut-wrenching corrections we've all been through? Or is the halving cycle, the theory that literally built fortunes, is it officially dead?
All right, so let's get into it. We're going to tackle this like a detective story. Think of the 4-year cycle as our victim, and our job is to find the culprit. Because all the evidence, and I mean all of it, suggests this isn't just another market dip. No, this is a fundamental rewiring of crypto's DNA. It's being driven by forces that are, well, they're completely changing the game.
So what's really interesting here is the story this chart tells. Just look at the drawdowns from the last cycles. Absolutely catastrophic drops. We're talking 85%, 84%, 77%. And every single one of them was kicked off by some kind of crypto-native implosion, right? A self-inflicted wound like Mt. Gox or FTX. But this time, the drawdown is a less severe 54%. And the catalyst isn't some internal fraud or failure. It's a macro/liquidity shift. So the key takeaway here is that the very DNA of this downturn is completely different.
And that right there brings us to the first major clue in our investigation. This crypto winter, or whatever you want to call it, it's not a repeat of the past. Not at all. It's a whole new kind of beast, and it's being driven by these powerful external forces, not the internal rot we've seen before.
So let's really break this down. The 2022 winter, that was all about systemic collapse. It was a crisis of confidence, plain and simple, caused by fraud and insane overleverage. But this 2026 winter, it's all about a macro pause. And this is what makes it so fascinating. We've got 172 public companies holding Bitcoin on their balance sheets, but the price is still struggling. Why? Well, it's because this isn't about a fear of crypto anymore. It's about institutional investors getting nervous and pulling back from all risk assets because of all the global economic uncertainty out there.
And boom, this number right here just perfectly illustrates the point. 91%. That's Bitcoin's correlation with the S&P 500. It's staggering. It means Bitcoin isn't just trading in its own little sandlot anymore. Nope, it's acting just like a high-growth tech stock, moving in lockstep with Wall Street, not with gold. It is officially graduated to the main stage of global macro assets. For better and maybe for worse.
This quote just perfectly captures the new reality we're in. Think of the last decade as like crypto's wild, speculative startup phase. Well, we're now in the post-IPO era. The market is finally maturing, the whole narrative is shifting away from just hype and memes to actual fundamentals, real use cases, and, yeah, the boring but absolutely essential work of building real infrastructure with clear regulatory rules.
Okay, let's get to our next piece of evidence. And honestly, this one is a total game changer. Just as the market was starting to mature, one of its oldest and most powerful adversaries completely flipped the script. I'm talking about the US government. It's no longer just auctioning off seized crypto. It has become a strategic holder, a hodler.
And this isn't just some political talk either. This is official policy straight from President Trump's executive order in March 2025. This single mine marks a seismic shift. The US government went from seeing digital assets as a threat that needed to be contained to seeing them as a strategic resource to be harnessed for national prosperity. It's a huge deal.
So what does this actually mean in practice? Well, it means the government set up a strategic Bitcoin reserve. It means that massive stash of forfeited Bitcoin is now off the market. They're holding it, not selling it. And then you have proposals like the Bitcoin Act of 2025, which would let the Treasury buy up to 1 million BTC. The government could become the biggest whale of all. This just fundamentally changes the whole supply and demand picture. But, and it's a big but, those trillions in institutional money, they're still waiting for the Senate to clear the final regulatory hurdles.
All right, so while Bitcoin's been navigating its new role on the global macro stage, the other titan of the crypto space, Ethereum, has been going through its own profound identity crisis. And it's a big one that's leading to a complete architectural overhaul.
And this right here, this statement from Vitalik Buterin back in February 2026, it sent absolute shockwaves through the entire developer community. For years, the official roadmap was crystal clear. Layer 2 networks, the L2s, were going to do all the heavy lifting for scaling. This quote signaled a radical pivot away from that vision they'd held for so long. So let's look at this shift.
The old vision was roll-up centric. The idea was that the main Ethereum chain, the L1, would just act as this super secure base layer while all the real activity happened on these external L2s. Well, the new vision brings all that activity back home. The goal is now L1 native scaling, and they're aiming for the L1 itself to process an incredible 10,000 transactions per second.
So how on earth are they planning to do that? The key is this major upgrade, codenamed Glamsterdam, which introduces something called parallel processing. And the analogy here is just perfect. It's like turning a congested, single-lane road into a massive, multi-lane superhighway. Instead of handling transactions one by one by one, the network can process a whole bunch of them at the same time. This unlocks enormous capacity, right on the main chain.
Okay, so let's recap. We have a market that's now tied at the hip to macroeconomics. We have a government that's hodling, and we have a radically re-architected Ethereum. With all this evidence on the table, the big question is, where does the market go from here? Let's walk through the 3 most likely scenarios for the rest of 2026.
All right, first up, the bull case. We're calling this one the institutional renaissance. This is the future where everything, and I mean everything, falls perfectly into place. It's when those trillions waiting on the sidelines finally get the green light to jump in. So what are the triggers? Well, you'd need clear regulation, like the Clarity Act passing the Senate. You'd need a friendly macro environment, with the Fed resuming rate cuts. And you'd need a flawless, successful Glamsterdam upgrade for Ethereum. If all that happens, we could see Bitcoin pushing up toward $180,000 and Ethereum heading towards $8,000 as a flood of institutional capital just pours in. Okay, next up is our base case, which we can call the stagnant transition. This is basically the muddle-through scenario. It's defined by political gridlock in Washington and a whole lot of economic uncertainty.
The triggers here? Well, that big Clarity Act gets delayed in the Senate. Inflation stays annoyingly persistent, so the Fed just pauses. And institutional adoption, it keeps happening, but at a very slow pace. In this world, Bitcoin and Ethereum would probably just trade sideways in a really wide range, reflecting a market that's just kind of cautious, in a wait-and-see mode.
And finally, we have the bear case, the secular crypto winter. This is the perfect storm scenario, where basically everything that can go wrong does.
What would trigger this? Well, think of a major geopolitical shock or a big spike in inflation that forces the Fed to actually hike rates again. Combine that with a catastrophic technical failure in Ethereum's super important Glamsterdam upgrade. That 1-2 punch would absolutely shatter investor confidence and would likely send Bitcoin back down towards its cost of production, around $45,000. And Ethereum, well, it could go way below $2,000.
So, after laying out all the evidence, all the possible futures, what's the final verdict in our little investigation into the death of the 4-year cycle? Well, the conclusion is that we're not just in a different price cycle. We're in a new type of cycle altogether.
This quote from James Butterfill over at CoinShares just says it all, doesn't it? For a decade, crypto was this experimental, parallel financial system running alongside the old one. That era, it's over. Now, it's becoming the actual foundational plumbing for the future of finance, and it's being integrated directly into the global economy.
So the most crucial point is this. The old 4-year cycle, the one driven by retail speculation and a simple supply shock, it's dead. And in its place is a new infrastructure cycle. The advice now isn't just to watch the price, it's to watch the building. This winter isn't about hibernating, it's about construction. It's about laying the regulated, scalable rails for the next decade of finance.
And that brings us right back to the central question. After seeing all the evidence, the deep institutional integration, the government's pivot from adversary to holder, and the massive re-engineering of Ethereum, what do you think? Are the old rules broken for good? Are you still a believer in the magic of the 4-year cycle? Or are you a skeptic, totally convinced that we've entered a brand new era? The future of the entire market really hangs on that answer.